Retiring in just 10 years through dividend investing, starting with $0. It sounds like an impossible dream, doesn't it? But today, I'm going to show you how this ambitious goal is entirely achievable, even if you're starting from absolutely nothing. This isn't another get-rich-quick scheme. It's a systematic approach to building lasting retirement income through the power of dividend investing. The conventional wisdom says you need 30 or 40 years to build a retirement nest egg. You're told to work until 65, maximize your 401k, and hope for the best. But what if there was a different path? What if you could create a sustainable retirement income stream in just a decade through strategic dividend investing? Today, I'll show you exactly how to achieve this, step by step, using proven strategies that have helped many investors retire early. Let me be transparent. Achieving this goal doesn't require a high-paying job, an inheritance, or even a degree in finance. What it does require is understanding how to harness the power of dividend investing, combined with disciplined execution and patience. Over the next 30 minutes, I'll share a comprehensive blueprint that can help you build a dividend portfolio capable of generating over $50,000 in monthly retirement income. Enough to not just retire, but to retire comfortably and confidently. Before we dive into these life-changing strategies, take a moment to subscribe and hit the notification bell, because the strategy I'm about to share has helped thousands achieve early retirement through dividend investing, and you won't want to miss a single step of this wealth-building blueprint. Think about what true financial freedom would mean for you. Imagine waking up every morning knowing your bills are covered, your lifestyle is funded, and you never have to worry about running out of money in retirement. This isn't just about accumulating wealth. It's about creating perpetual income streams that grow over time, protecting you against inflation and market volatility. By implementing the strategy I'm about to share, you'll learn how investing just $20 a day, about the cost of a casual lunch, can potentially grow into a multi-million-dollar portfolio, generating substantial passive income. We'll focus on selecting high-quality dividend stocks and ETFs that not only provide reliable income, but also increase their payments year after year, ensuring your retirement income grows over time. The path from zero to retirement in 10 years might seem daunting, like looking up at a mountain you need to climb. But just as every journey begins with a single step, building your retirement through dividends starts with understanding the right strategy and taking consistent action. Whether you're in your 20s dreaming of early retirement or in your 50s looking to accelerate your retirement planning, this approach can work for you. Let's begin by exploring how to build your initial investment capital, even if you're starting from absolutely nothing. Zero to hero. Building your money engine. Starting with zero doesn't have to be daunting. In fact, it's an opportunity to build something extraordinary through strategic action and smart choices. Most people believe building wealth requires significant upfront capital, but I'm going to show you how starting from nothing can actually be your greatest advantage, giving you the flexibility to implement cutting-edge wealth-building strategies from the ground up. Let's explore 3 powerful methods that go beyond typical advice. First, consider specialized skill monetization. While others might suggest basic delivery services or ride-sharing, I'll show you how to leverage high-value skills in today's digital economy. For instance, technical writing for blockchain companies can earn you $75 to $100 per hour, or specialized data analysis for small businesses can generate $60 to $80 hourly. These opportunities require minimal startup costs, but offer maximum return on your time investment. The second strategy involves what I call smart automation stacking. Yes, micro-investing apps like Acorns and Stash are useful, but let's take it further. Imagine combining multiple automated saving tools with cashback optimization. For example, linking your regular purchases to a high-yield cashback card, automating those rewards into a dividend-focused investment account, while simultaneously running a roundup program on your transactions. This triple stacking approach can generate 15 to 20% more capital compared to using these tools individually. Here's where we elevate beyond basic advice. Consider implementing what I call the digital asset ladder. Start by creating digital products once, whether it's templates, guides, or online courses, and sell them across multiple platforms. Unlike traditional side hustles that trade time for money, Digital assets can generate passive income while you sleep, accelerating your journey to dividend investing. One well-positioned digital product could generate $500 to $1,000 monthly with minimal ongoing effort. But here's the crucial differentiator. Instead of treating these income streams as separate entities, we'll create a systematic funnel where every dollar serves a specific purpose in your dividend investment strategy. For instance, allocate 70% of your side income directly to dividend investments, 20% to scaling your most profitable ventures, and 10% to exploring new opportunities. This structured approach ensures you're not just earning extra money, you're building a wealth generation ecosystem. Remember, while others might be satisfied with earning an extra few $100s monthly, our goal is to build a foundation for significant dividend income. By implementing these advanced strategies systematically, you could potentially generate $2,000 to $3,000 monthly in extra investment capital, far exceeding what typical side gig advice might yield. Cracking the dividend code. Now that you have your foundation in place, let's discuss something crucial that most dividend investors overlook: strategic capital deployment. This isn't just about randomly picking high-yield stocks. It's about creating a sophisticated framework that maximizes every dollar you invest. While others might suggest simply buying popular dividend stocks, I'm going to show you a more refined approach that could potentially double your dividend income over time. Understanding dividend investing requires grasping a fundamental truth. Not all dividend payments are created equal. Think of dividends as a company's financial report card. They tell you much more than just the yield percentage. When a company consistently increases its dividend payments year after year, it's demonstrating both financial strength and a commitment to shareholder returns. This is where our strategy begins to diverge from conventional wisdom. Let's talk about dollar cost averaging, but with an important twist. While traditional advice suggests investing fixed amounts at regular intervals, we'll implement what I call strategic scaling. This approach involves increasing your investment amount systematically as your dividend income grows. For instance, if you start with $20 daily investments, you'll increase this amount by 5% every time your dividend income reaches certain milestones. This creates a powerful acceleration effect that most investors miss entirely. The real magic happens when you combine this with automated dividend reinvestment programs, DRIP. But here's where we'll take it further. Instead of reinvesting dividends back into the same stocks automatically, we'll use a dynamic reallocation strategy. This means directing reinvested dividends toward the most undervalued dividend opportunities in your portfolio, maximizing both yield and growth potential. Consider this. While the average investor might be satisfied with a 4% dividend yield, our strategic framework aims to achieve what I call yield optimization. This involves carefully balancing high-yield investments with dividend growth stocks, creating a portfolio that not only provides substantial current income, but also ensures that income grows consistently over time. The goal isn't just to match inflation, it's to significantly outpace it. Here's something your financial advisor probably never told you. The power of dividend investing isn't just in the payments themselves, but in the compounding effect of rising dividend payments. When a company increases its dividend by 7% annually, that means your effective yield on your original investment is growing exponentially. A stock purchased with a 4% yield today could be yielding 8% on your initial investment in just 5 years through dividend growth alone. Blueprint for a wealth-building portfolio. Now let's dive into the most crucial part of your journey: constructing a dividend portfolio that can truly support your early retirement goals. While many investors focus solely on chasing the highest yields, we're going to take a more sophisticated approach that balances immediate income with long-term growth potential. This strategy has helped countless investors achieve their retirement dreams years ahead of schedule. When building your dividend portfolio, you essentially have two primary vehicles: individual dividend stocks and dividend-focused ETFs. Let's examine how to leverage both for maximum advantage. Individual dividend stocks offer you precise control over your investments and often higher yields, but they require more intensive research and monitoring. Dividend ETFs, on the other hand, provide instant diversification and professional management, though typically with slightly lower yields. Here's where our strategy becomes particularly powerful. Instead of choosing between these options, we're going to implement what I call the hybrid dividend matrix. This approach combines the stability of blue-chip dividend aristocrats with the growth potential of carefully selected REITs and the diversification benefits of dividend ETFs. This creates 3 layers of income streams, each serving a specific purpose in your retirement plan. Let's examine the key sectors that should form the foundation of your portfolio. Utilities offer stability and high yields, typically paying out 3 to 5% annually with remarkable consistency. Consumer staples provide recession resistance. People need these products regardless of economic conditions. REITs can deliver yields exceeding 6% while offering exposure to real estate markets without the hassles of property management. Financial sector dividends tend to grow faster than average, particularly in rising interest rate environments. What sets our approach apart is the implementation of what I call yield zone targeting. Instead of simply picking stocks with the highest current yields, we create specific yield targets for different portions of your portfolio. For instance, 40% might target stable 3 to 4% yields with strong growth potential, 35% might focus on 4 to 6% current yields, and 25% might seek yields above 6% from carefully selected REITs and specialty sectors. This balanced approach helps manage risk while maximizing both current income and growth potential. Consider this often overlooked strategy, focusing on companies with low payout ratios but consistent dividend growth. While their current yields might be lower, these companies often have more room to increase dividends substantially over time. A company paying out only 40% of its earnings in dividends can more easily double its dividend compared to one already paying out 80%. This forward-thinking approach can dramatically increase your income over the years. Supercharge your investment growth. Let's explore how to supercharge your dividend growth through advanced compounding strategies. While most investors understand basic dividend reinvestment, we're going to implement what I call strategic compound acceleration, a method that can potentially double the speed of your portfolio's growth. This approach goes far beyond simple DRIP programs, incorporating multiple layers of optimization that most investors never consider. The foundation of our acceleration strategy begins with understanding the power of dividend reinvestment timing. Rather than automatically reinvesting dividends as they arrive, we implement a strategic reinvestment calendar. By analyzing payment schedules across your portfolio, you can optimize when and where each dividend payment is reinvested. This methodical approach allows you to take advantage of market dynamics and price fluctuations, potentially increasing your returns by an additional 2 to 3% annually. Consider this scenario. A typical dividend portfolio might generate payments from different companies throughout the month. Instead of reinvesting these dividends immediately, we pool them strategically and deploy them when specific valuation triggers are met. This approach allows you to accumulate larger positions in undervalued dividend stocks while avoiding overvalued ones, essentially buying more shares when they're offering better value. Here's where we implement what I call the dividend velocity formula. This involves systematically increasing your investment amounts as your dividend income grows. For instance, when your monthly dividend income reaches $500, you increase your regular investments by 10%. At $1,000, you increase them by another 15%. This creates a powerful acceleration effect. Your growing dividend income directly fuels faster portfolio expansion. Most investors overlook the impact of tax efficiency on compound growth. By strategically placing higher-yielding investments in tax-advantaged accounts while keeping qualified dividend payers in taxable accounts, you can significantly reduce tax drag on your returns. This alone can preserve an additional 10 to 15% of your dividend income for reinvestment, accelerating your portfolio's growth substantially. One of our most powerful acceleration techniques involves what I call yield layering. Instead of focusing solely on current yield, we create multiple layers of dividend growth rates within your portfolio. Some positions might yield 3% but grow at 12% annually, while others might start at 6% with slower growth. This strategic layering creates a compounding effect that becomes increasingly powerful over time, potentially turning a $20 daily investment into that significant monthly income we discussed earlier. Now let's translate these numbers into a clear roadmap for achieving your dividend income goals. I want to show you exactly how investing just $20 a day can grow into $50,000 monthly income through the power of compound growth and dividend reinvestment over a 20-year period. Let's start with understanding what $20 daily really means for your investment journey. By investing $20 every day, you'll be putting away $7,300 annually. Over 20 years, your total out-of-pocket investment will be $146,000. While this might sound like a lot of money, it's actually quite achievable when broken down into small daily commitments, about the cost of a casual lunch or a few coffee shop visits. To generate $50,000 in monthly income, or $600,000 annually, we need to build a portfolio large enough to sustain these payments. With a realistic 4% dividend yield, which we can achieve through a carefully balanced mix of dividend stocks, REITs, and ETFs, we'll need to grow our portfolio to $15 million. Don't let this number intimidate you. The power of compound returns makes it more achievable than you might think. Here's where the magic of compound growth comes into play. To reach our goal, we need our investments to generate a total annual return of about 26.8%. This comes from 3 different sources working together. A 4% dividend yield providing immediate income, a 12% dividend growth rate as companies increase their payments over time, and 10.8% share price appreciation as our investments gain value. Let me show you how this growth unfolds over time, like watching a small seedling grow into a mighty oak. In your first 5 years, your portfolio would grow to around $168,000, generating about $6,720 in annual dividend income. This might not seem like much, but it's laying the crucial foundation for future growth. By year 10, things start getting more interesting. Your portfolio would reach approximately $890,000, providing $35,600 in annual dividend income. You're now earning back about half of what you've invested each year just in dividends alone. This is when the power of compound growth really begins to show itself. The real transformation happens in the second decade. By year 15, your portfolio would grow to around $4.65 million, generating $186,000 in annual dividend income. Notice how the growth is accelerating. This is compound interest working in your favor. Each dividend payment gets reinvested, earning its own dividends, creating a snowball effect of growing wealth. Finally, at the 20-year mark, your portfolio reaches its target of $15 million, capable of generating that desired $50,000 monthly income through dividends alone. This is the power of patience and consistent investing combined with compound growth. Now, you might be wondering if these returns are realistic. While they're certainly ambitious, they're designed to be achievable through a carefully structured portfolio. Think of your portfolio like a well-balanced meal. 40% in dividend growth ETFs providing stable growth, 30% in high-yield REITs offering stronger current income, and 30% in individual dividend growth stocks for additional growth potential. This combination helps capture both immediate income and long-term growth while managing risk through diversification. The 20-year timeline is crucial for making this work. It gives you time to reinvest dividends in the early years when you don't need the income, allows you to buy more shares during market downturns through dollar-cost averaging, and provides a buffer to recover from market fluctuations. Think of it like growing a garden. You need to give your plants time to mature and bear fruit. Remember, this strategy works best when you stay consistent with your investments and reinvest all dividends during the growth phase. Each dividend payment should be viewed as a seed that can grow into its own income-producing tree over time. By staying patient and letting compound growth work its magic, you can build a dividend income stream that provides financial freedom in retirement. Think of this 20-year journey as building your own money-generating machine, piece by piece, day by day. Each $20 investment is another component that, when combined with time and compound growth, creates a powerful income-generating engine that can support you for years to come. The key is starting early and staying consistent, letting time and compound growth do the heavy lifting for your financial future. Remember, successful investing isn't about timing the market perfectly. It's about committing to a proven strategy and maintaining consistency. The sooner you begin, the more time your investments have to compound and grow. Subscribe to this channel for weekly insights on dividend investing strategies, market analysis, and detailed stock breakdowns. Hit the notification bell to ensure you never miss our latest research and recommendations for building lasting wealth through dividends. This video is for educational and informational purposes only. Past performance does not guarantee future results. Always conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions.